Alright guys, today I'm going to explain liquidity to y'all because this is a very important fundamental concept that you have to know as a trader. It's like one of the basic things that you need to know. So let's get into it. Alright, so first of all, what is liquidity? Liquidity is resting orders. Okay, so that could be a resting buy order, or a resting sell order, or a limit order, or a stop loss. And okay, so let's say that doesn't make sense, right? Because it kind of sounds confusing at first. Basically, if I take a long position, right, and I just buy wherever, let's say I make a long position, right, this stop loss is a resting order, and this take profit is also a resting order, but we're not going to talk about take profits. So stop loss, this is a resting order. What does that mean? That means if price goes down here, that means you're going to be selling your shares back to the market, right, for a lower price than you bought them for. So that means if price goes down here, you've sold, you're out of your position. That means you're giving your shares back to the market. So if the market had 10 total shares in it and then you buy 5 in this position, then throughout this entire position, the market only has 5 shares in it. Okay, but as soon as you get stopped out, the market goes back to having 10 shares. So you're giving your shares back to the market. If you think of it as like a farmer's market or something, or like a flea market, whatever, just think of it as like if you want to sell, right? If you want to sell something, somebody has to buy it from you. If you want to buy something, somebody has to sell it to you. This stop loss is essentially somebody selling you their order, okay? So if you buy right here, then that means somebody sold you their order, their shares. So at this level, if your stop loss is right here, and price stops this person out, this first trader, then they just sold their shares to the market because they got stopped out. But this person right here is buying at this level, so this person's trade just got entered in and only got entered in because this person's trade failed, okay? So since this person sold their shares, this person was able to buy those shares that were just sold, and then their position can go up and hit take profit, whatever. That's basically liquidity. It's just resting orders, and these orders that are resting are usually above or below highs and lows. So if you look at this right here, we have a high right here. Okay, I'm going to mark out this. Let me turn my magnet. I'm going to mark out the high. It's a high right here. Why is this high important? Because there's liquidity above this high. So let's say it doesn't make sense still, because it is a pretty confusing concept to get at first. What this means is that people at this high are going to be, like, let's say somebody is shorting, let's say somebody shorts right here, okay? Their stop loss is going to be in this pool of liquidity. Their stop loss is going to be liquidity. Let's say we're doing a long-term trade, okay? Because this is the 4-hour time frame. Let's say you want to target like these lows right here. And I purposely put it past this low right here because I wanted to show you guys an example where this trader would fail, because it helps explain liquidity. Okay, so basically, if you short right here the market, right, then your stop loss is right here. So this is a resting buy order, okay? Think about a short. When you short a position, you're selling you're selling shares right here. You're selling 5 shares, for example. You want to buy back those shares when they're all the way down here, so that you shorted them at like $5 and you're selling them back or you're buying them back at $1. So if you sell 5 shares, if you sell 5 apples, right, at $5, you just made $25, okay? And if you have to have 5 apples by the end of the day, you want to buy them back for like $1, because that means that you sold for $25, so you made $25, you're up $25, but you still have to buy those apples back because you can't, like, you still need 5. It's kind of a weird example, but if you buy them back right here for $1, then that means you spend $5 to get back those same 5 apples that you initially sold for $25, which means you have a net profit of $20, okay? So that's basically shorting, and why that's important is because if price never hits this and you never end up selling those apples for $1 back, and instead you end up getting stopped out, which is what would have happened if you took this trade, then that means you're buying your apples back for a higher price. So if you sold them for $5 right here, but it goes up and you get stopped out, then you're buying them back for like $10, which means you're losing money. Okay, but what's important, what you should take away from this is that you have the resting order to buy back these apples at $10. That's right here, okay? And an institution, like a bank or an institution, a market manipulator that has like thousands of dollars and thousands of orders that they want to fill, like they want to buy all the apples when people are getting stopped out right here. There's a fly right there. They want to, what was I saying? They want to target people's stop losses because they know that at a stop loss, somebody is going to have to buy. Okay, so that means if an institution wants to short the market, right? If an institution wants to tank the market and make it crash, they want to sell, okay? But if they want to sell, they need somebody who's going to buy, which is why right here, this is where people are buying at the stop loss, okay? Remember, they're shorting. If they get stopped out, they have to buy their shares back. Okay, now you have to think, who's going to sell those shares to them? The institution. So the institution is going to be like, at the liquidity right here, the stop loss, which is right there. If we can go up to this, if we can push price up to this level, or if price goes up to this level, that means like thousands of traders are going to get stopped out on this short right here, okay? So what that means is the institution is going to be like, great, if they're getting stopped out right here, that means that they're all buying back their shares. And then the institution, after they say that, they're going to say, okay, well, why don't I sell them those shares that they're going to buy back? So the institution can actually sell their shares right here because these people are buying them by getting stopped out. And so when the institution sells their shares, they are shorting the market, like right here, at the line, like right there. So that means they're shorting the market, and they can target, like, because they're putting like millions of dollars and billions of dollars into these orders, right? Whereas this guy would just be putting like $500 or, you know, one contract on NASDAQ, which is like $500, $600. This institution is putting like billions of dollars in. So that means when you put billions of dollars in the market, then price is going to move more as a result. So they actually manipulate and move the markets. That's why they call the market movers and the market makers. So yeah, the institution can sell the shares right here because there's people who are buying them because there's so many stop losses here. So that's liquidity essentially, is when there's an area on the chart where a ton of people have resting orders. So like a bunch of stop losses could be right here, a bunch of limit orders could be right here. But you don't really need to understand like the different types of orders that are there. You just need to understand that there are orders there and they're above these highs. Basically what you need to understand, like the simplest way to understand liquidity is that whenever there's a high, price, if it hits that high, it has potential to reverse because of the example that I just showed you guys, where it can sweep out this high, it can take out some stop losses and some sell orders, whatever, it can take out some buy orders, and then it can tank, okay? So whenever price hits a high, if it's a prominent high, it has potential to reverse. The same thing applies for lows. You can see there's a low right here and a low right here. There are resting orders at these lows, okay, because people see this huge move, and so they think whenever price hits this low again, I'm going to short or I'm going to buy or whatever. They're going to put a resting order there. A market maker, knowing that there's so many orders lying right here at the bottom of this low, can literally just push price down to take out those orders. And then let's say it's a long position right here. Let's say a trader put like a long position off this candle because they thought it was going to reverse, and they put their stop loss below the low, which is what most people do. They just put it below the low or at the low, whatever. And let's say another trader put another long position right here with their stop loss at the low. Maybe it's right there. Maybe it's at this low. The point is that there's a stop loss at the low. Okay. A market maker will wait for price to do whatever and then come back down to where these stop losses are. And then as soon as these stop losses get filled and they get hit and these two people are taken out of the trade, they lost money. That means that at the stop loss, they sold their buy position back to the market. And so the market maker is going to be like, great, I'm going to buy your buy position that you just got stopped out on because you no longer can hold on to it. You just got stopped out. So I'm going to buy it from you. They put an order right here and they target the next high. And then they essentially move the market in their favor. So basically, liquidity happens below lows and above highs. And whenever liquidity is swept, like you can see right here, liquidity got swept. You can see right here, liquidity got swept. This high got swept. Whenever liquidity is swept, price has the potential to reverse. And it's literally happening right now. Price is literally reversing off of this liquidity. So you could essentially see price go down and take out this liquidity right here, which is now formed hold on, I'm saying a lot of stuff right now, but this low right here is a new low where liquidity is. Okay, so it's the exact same thing. What do you think is going to happen when price hits this? Okay, it's going to it could potentially reverse to where you could get a position like this where you catch the move to the next liquidity zone, which is right here. Okay, and it's and dumb people, sorry, I shouldn't say that. Support and resistance people will just be like, yeah, it's just bouncing off a wall. That's why support and resistance exists. It's because it's a simplified form of liquidity. Okay? But understanding liquidity for what it actually is and not just dumbing it down into support and resistance because you want to get like a really quick understanding or whatever of it. Understanding what it actually is will help you way more as a trader than just saying, oh, there's a ceiling right there or whatever. My computer's about to die, so I'm going to end the video. But hopefully that helped you guys understand liquidity. Again, you guys can ask me any questions you want to ask me in the Discord, 100% free. I need to plug in my computer, so I'm going to end the video quickly. But yeah, asking me any other things that you guys need help explaining. I'll get this out in the Discord. Peace.